Hello, you're watching Smart Money, and today we're talking building a trading strategy in the age of AI. How much of it driven by AI-powered insights? How much still relying on human discipline, risk management, and experience? MJ Givens Kgasi, an analyst at Octa, joins us now with his take. MJ, good to have you with us. And I'm going to launch straight into things because there's no denying that AI is a powerful tool to be leveraged, right? But you've cautioned against an over-reliance on technology, even if it is said to be revolutionizing the way things are done across the board. So when it comes to trading, how should traders be balancing technology with personal judgment and discipline?
Well, thank you so much for having me. Well, I think it's clear we are going to embrace the whole evolution of technology. But we gotta say, I think the only thing that the AI would benefit a trader at this point is that it doesn't have emotions, and that's what most traders are struggling from. But now the only problem comes and the danger comes when people only follow AI signals blindly without understanding the context and managing risk. You also have to have the interpretation of what it will put to you, right? So what we see is that you have a lot of traders thinking that there is no need of education, there is no need of experience. They might have just jump into AI and it's going to make them money overnight. And that is the only misconception about the whole experience of AI. Discipline and clear strategy at this point is also very important, right? Because you will normally have tools that are going to be. I mean, if you use ChatGPT, for example, to find out information about what is happening globally, right? You will still need to know what to type. The prompt that you have to put, you still need to know, because if you don't know what is it that you're gonna put, and there has to be an interpretation as well. I mean, whatever results it's gonna give you, it will also, AI would depend on you to have a formal interpretation of what is going to be put. I mean, we have seen, ChatGPT will even go to a length of saying this is not financial advice. What does it tell you as a trader? There must be a hybrid approach. And I'm preaching this everywhere I go. Let us utilize technology, but the human element is very important to also put in.
Absolutely, especially where personal judgment is informed or influenced by experience and tried and tested strategies, right? In fact, you go as far as saying that it's experience that gives one the edge in trading. So to what extent?
Well, look, I mean, we remember that the worst enemy you can ever find in trading can be yourself. I spoke about the emotions element. And you find people having good strategies, but they cannot contain themselves in regards to positions that they execute, right? What do I mean? You have people that are having experience, they have a good strategy, but they mess it up because of the emotions are not being controlled properly. You're having, individuals that are also having trauma experiences from growing up. We always want to be a winner. I myself have been in the industry for more than 10 years, and I struggled from trying to win all the time, right? And that's where now you forget about risk management. How do you reassess exposure? Because you just want to win. You are having this mindset, I have to win all the time. And it's clearly not about that. I mean, if you have a system that gives you a good risk reward, look, I use 50, but when I win, I have to gain 100. It's as simple as that. I mean, even if you win 50% of the time and you lose 50% of the time, you are still profitable because your risk management is proper. You're going for a risk reward ratio of 1:2, 1:3, right? Of which this is what you could appreciate also about AI. I mean, if you are going on the charts and you don't know if we normally call them psychological levels. I don't know where is support, where is the resistance. Can I see it with the naked eye? Maybe you're not that experienced to see it with the naked eye, but with the use of AI, you can simply say, look, I want to buy USD ZAR at 17 Rand 90. Is this my support or not? And, with a bit of help from AI, it can assist you with that. But again, if you don't have experience, you are always going to find yourself, chasing the markets. And I always say markets are not risky, right? The lack of preparation is. The less you are prepared, the more likely you are going to get hit by these markets. As I've mentioned earlier, you can be your worst enemy. And yeah, I think we can appreciate artificial intelligence in regards to it doesn't have emotions at all.
So, MJ, let's talk through trading during high impact events because that becomes even riskier, right? So, what's your advice to new traders trading through high impact economic events like CPI data releases, central bank meetings, or geopolitical shocks, which all create huge market volatility and massive risk?
Yeah, well, look, I think if you are a newbie, stay away from high impact news, right? And I'll say why. I mean, you can experience liquidity gaps, you can experience even possible slippages, and one can ask, what is slippage? I mean, if, as I mentioned, you want to buy an instrument at 18 Rand 70 and you get filled at 18 Rand 90, that simply means you are not filled at the price in which you wanted to, right? And it's expensive for you because if you want to buy something, you're always going to look for the possible discount you can get, right? Because once your price is discounted, more likely that you're going to make money, right? And during high volatility times, you are not guaranteed. Even your stop loss might not even be triggered. You might say, I want to lose $100 on this during high impact news, but look, it's not guaranteed, right? You might lose more than that. So it goes without saying again that if you don't know what you're doing, rather stay away, let the market settle in. I always do it myself, with the experience that I had. After CPI release, NFP, look, give yourself 15 minutes to 30 minutes, let the market breathe and make a decisive decision from there. So I would say from the costing perspective, and also emotions. I mean, if you are just seeing market just moved in a short space of time, you can imagine what is happening to you psychologically, right? So I would say just stay away and give the market some time to breathe, then you can jump in.
If you don't have the experience, that's what I got from that answer there. So there are situations where traders can safely approach high volatility events, right?
Yeah. No, most definitely. I think again is if you're going to approach it, for example, try to go as little risky as possible. Don't expose too much, right? Because chances are, I mean, for me, it's always, debatable in the industry. It's 50% chance. And you don't want to approach this business with a gambling mentality. If maybe it's going to go my way, it's not going to go my way. Trading is not about being predictive, but rather being about reactive. All right. So react to what you see rather than predict what's going to happen. Because I think we've been seeing a lot of prophets of doom in the industry where they get it wrong. And you don't want to run your business based on that, right? You want to make a proper evaluation of how much you're going to expose and how much you're willing to let go and how much you're willing to gain. So I would say, well, if you're going to approach it, go as little as you can, expose a little rather than, hating yourself in this regard.
Enter trade management then, right? The importance of trading plans, knowing when not to trade. Because one of the biggest myths in trading is finding the perfect entry point. I mean, many chase the perfect entry point, but you argue that trade management trumps timing. So why is that? And what's the difference between the two?
Well, look, I think as a female, you would understand this better. Have you noticed that most females, from growing up, they journal their lives, right? Dear diary, I'm sure you would know it. And what that does is that you can connect with your emotions from yesterday, and that tends to help you making better decisions the next day, right? So the journaling also helps you with that. I mean, if you're going to write down the experience of today, you're most highly likely to improve from the mistakes that you've made, right? It's gonna go from emotions, psychology, money management, what is basically happening with yourself. I mean, even your how do you wake up in the morning? Myself, I always say, if I don't get enough 8 hours of sleep, I don't trade at all because I don't have that capacity and that belief in myself that I can do it. Not to say that I don't do it, but I've put a process and a system, right? That guides my business because you want to trade in such a way that if you're going to give it to somebody to carry on with it, you have a process, you have a system that you say, look, This is a blueprint of how I managed to run this business for all these years. You can try it out. And also, background again plays a very important role, right? And that's why generally is important. You have people that are struggling from ADHD. They cannot sit in front of the charts for a long time. They're struggling, right? Hyperactivity is all in their minds. There are a lot of things happening in their minds. How does one person with ADHD approach the markets, right? First of all, work on yourself before you try work on the markets, right? Because if you can handle yourself, I believe you can handle the markets are external. But if you can handle internal demons, you are most likely to be able to have a strategy of handling external, forces that you might experience.
And MJ, what I got out of that is that women make for better traders, right? Of course, there are direct cost implications to consider as well. So, how do costs like overnight swaps, commissions, weekend exposure impact results if traders don't plan ahead?
Well, I said earlier on, I mean, the approach of trading, I think, has to be taken as a business. And I think I have to mention this, that in South Africa, unfortunately, it's not been seen, that, especially at the retail level, right? It's been seen as something that you can just do waking up and just get on the charts and get on your laptop and make money. This is a profession. This is a career, and this possibly is a business, right? The minute you mention cost, then you need to know how much does it take you to run your business on a monthly basis? What are your targets, right? You would appreciate, from Octa, and let me put this in. We don't have swaps commissions, for a reason, because we collect data from clients. Why we don't have that is because we know there is costing of doing business. But how do we solve their problem? You can be trapped, especially on Fridays. If you get in a market on Friday and you don't close your position, there are high chances that you're going to pay swap on Monday, right? But let me also say that there are rewards in that. If you sell euro dollar, most brokers will pay you for swap instead of taking something away from you, right? So there are benefits in that. But you have to understand that if I'm going to put a certain lot and I'm trading a certain instrument, if I leave it overnight, this is how much. And going again to general, write it down that this is a possible cost. It's an expense for this business, right? That I'm going to go over in the next maybe coming few days, because you remember you are getting different types of traders. You are getting swing traders, scalpers, day traders. Most of the time, swing traders are the ones that are being charged for this. But lack of preparation, again, it makes them feel like the broker is always against them, but because they didn't plan for it ahead. It's a cost of doing business. Every business, there is a cost, and you have to plan for it.
And in this day and age, there really is no excuse for lack of preparation. And I feel like the conversations come full circle here, because this is where tech can be leveraged, because it opens up access to data. That's where technology becomes this very powerful ally, right? Giving retail traders access to institutional level data and AI-driven insight. So is tech finally leveling the playing field?
Most definitely, especially for retail traders. There was a certain technology that was only available and accessible to hedge funds and institutions, right? But that technology now is at the disposal of retail traders. If you want to know what hedge funds and money managers are doing, right? Back in the days, it was quite difficult because you could not get that data. But now it is. With the help of AI, the interpretation of COT, which is the commitment of traders. If you go on any side now and you look at what hedge funds and money managers are doing, it can be overwhelming because it's a lot of information, right? What are their contracts going to the upside? Contracts going to the downside? Spread on that. Are they hedging at this point? If you go on ChatGPT and you just say, look, what is happening with regards to gold? Trading at 3,400, what is the COT data at this level? It can give you that information in a short space of time. That's now precision, speed. Again, it saves you time, right? And it allows you to stop making silly mistakes because you are not thinking of a lot of things that they go, all right? And I think we need to appreciate that. And that's what artificial intelligence has brought in the game, that it gives you much edge when it comes to, managing risk, getting data, and also trying to get as many articles as possible in a short space of time.
Absolutely. Well, MJ, it's been a pleasure catching up with you this morning. Thanks so much for having joined us in conversation. MJ Givens Kgasi is an analyst at Octa.